Good afternoon, everyone. It is Wednesday, September 14th. In light of yesterday's pretty volatile day in the market, I thought I'd take a second and share kind of what went down, why the market reacted the way it did, show a few slides, a few charts, talking about this inflation and interest rate environment, try to provide some more insights on what we're thinking here. As you've probably seen yesterday, inflation came in much higher than expectations. Expectations were for a year over year increase of 8.1%, ended up at 8.3%. More concerning than that, where I think we got the big move in the market was core inflation. Core inflation excludes food and energy. Food and energy are naturally more volatile. So they remove those numbers to try to get a more clear picture on what the rest of the inflation picture looks like. So that came in well above expectations. People were looking for more of a decline, and it was month over month, July to August of this year, and ended up coming in 0.3% higher than it was in August. The biggest component of that increase was shelter, rose 0.7% compared to July for the August number. That was the highest since 1991. So the cost of, sheltering yourself and your family is seeing a very large increase, mostly in rental prices, that has led that core number to be much higher, as it represents about a third of the core inflation number comes from shelter there. So anyway, market's negative reaction to that, because with inflation still coming in higher than expectations, that's going to lead the Fed to be more aggressive, raising interest rates and holding those interest rates higher for longer. Why are they doing this? What's the purpose? They're trying to bring growth down. Okay. When money is cheap, people borrow money and spend money. We've had so much of that over the last couple of years that now we need to bring money spending down a little bit, tame inflation, and slow the growth. As Chairman Powell said last month in his press conference, this is going to bring some pain across the country. People are going to lose jobs. People are going to lose benefits. It is a necessary evil to get inflation under control here. So let's take a look at what they've been doing and outline, kind of how this compares to history. So this is Fed funds increase in rates. They call them cycles, from when they stop raising, or excuse me, when they start raising to when they stop raising interest rates. Here are some very different hiking cycles. As you can see, 2015 was a very long hiking cycle, but it wasn't very aggressive. They didn't raise them very quickly. 2004 was kind of that happy medium, right? It went quite a long time, and it was a gradual increase. If you focus on the blue, that's this cycle, what we're doing right now. The Fed was extremely aggressive in getting this up to 2.25% for the Fed funds rate. And as a reminder, this is the rate in which the Federal Reserve, the government, loans money to banks, and then banks can turn around and loan that money to us. So very aggressive hiking cycle. People were expecting maybe at the end of this year to early 2023 to start to see some pausing in this interest rate increases. And that was obviously not going to be on the table now. They're going to have to be more aggressive with that. So now the market is pretty much 100% guaranteed. They believe that they're going to raise interest rates next week by 0.75%. And there's a 34% chance currently, the market suggests a 34% chance that they may raise it a whole 1 percentage point. So time will tell what they actually do, but they are going to continue to aggressively hike interest rates and keep them higher for longer until we see a better reading on inflation. What does this mean? So you have to look kind of closely here, but this is different. This is the federal funds rate over time. You can see there are periods when it climbs and then periods when it falls. And you can see preceding almost every single recession, which is shown in those gray bars, is an interest rate hiking cycle, which is what we're doing right now. You may be hearing a lot of the soft landing talk, which is rising interest rates, getting it to where it needs to be while not pushing us into a recession. As you can see, the track record for a soft landing is not very good. That would not be the expectation, although it is possible. So now we have to determine how far they're going to have to hike interest rates, and when they're done or when they get there, Are we entering into a recession that's going to cause larger unemployment than expected? Earnings per share on the average company you're invested in, are those going to suffer? A lot of questions yet to be answered, but the main theme here is with interest rates rising, the higher probability that we get pushed into a recession. And then the last thing I wanted to share, this is, to me, in my opinion, and some of the economists I subscribe to their research, is that this is the big sticky part, is the money that we're making, right? The average hourly employee is making more money today than they ever have. And what happens is if they make more money, they get to spend more money. When they're spending more money and there's not as many goods, right? You have more dollars chasing the same amount of goods and services, which is causing the prices of those goods and services to increase. We need to see the average hourly earnings come down back into that 2 to 3% range, which was the normal environment, as you can see, in order for the spending to calm down, and therefore we can get inflation to calm down. So until that happens, we still continue to expect inflation being quite the large battle, although we are seeing a lot more economists come out and say, we feel like inflation has peaked. Well, they were saying that the last 60 to 90 days, and this inflation number was quite the surprise. So long term, like when I say long term, I'm thinking maybe 6 to 9 months from now, we do expect inflation to, get under control. When that happens and the Fed can pause the rising of the federal funds rate, we expect the interest rates on the 10 years and the 2-year government bonds to come down a little bit, which is going to ease the pressure on the losses we've seen in bonds so far this year. As interest rates are rising, the value of bonds are coming down, and vice versa. So if we can get inflation under control, we can get interest rates to come down a little bit, so we can see our bonds kind of come back and appreciate in value some as well. So as always, we hope this update provided a little bit of insight on what's going on in the market. Give us a call or shoot us an email with any questions, and hope to see you all very soon. Take care.